Hey, everybody, we're going to talk Warren Buffett and Berkshire Hathaway today. Before we dive into our favorite Berkshire Hathaway stocks to buy right now, take a minute and check out fool.com/Frankel, the link you see on your screen. And it is the best way to support this work we're doing. You get the top 10 stocks to buy right now from the Motley Fool. Again, that is fool.com/Frankel. So we're going to talk about our favorite Berkshire Hathaway stocks to buy right now. Mine is probably not one you think. It's one that I've never talked about on the channel before, but I'm going to kick it over to Tyler first because Tyler always has the more fun outside the box stocks to talk about. Which stock in Berkshire Hathaway's massive portfolio are you looking at right now?
So I think for both of us, we went to the B side of the Berkshire 13F. If anybody even remembers what a B side is, maybe I'm dating myself here, but we'll just call it a deep cut. And what I actually found, and one that looks particularly interesting to me, is Aon PLC. AON is the ticker, same as the name. And basically they are, they say risk management, casualty management. They're an insurance company as well as a consultancy that does risk management things that typically involve insurance products. Maybe that's workman's compensation, wealth management, that whole spectrum of things that typically get involved when you're either brokering or underwriting insurance. It's a lot of business to business kind of insurance. You're not going to get your auto loan from these guys. You're not going to get your, your Aflac supplemental insurance or something like that for your health. This is very much like property and casualty for businesses and a lot of specialty situations that we don't normally see. And it's kind of like we'll call it an illiquid market relative to the typical or typical insurance that we think of when we buy, off the shelf sort of products for autos. One of the things that in general, to me, this is just one of those like durable businesses that it's going to last forever. If you're an underwriter or a broker of insurance, you're delivering to a client some sort of like specialty solution to insure against risk. That's been around for millennia, and I can't see any situation where we, AI or blockchain away risk that insurance doesn't exist anymore, right? I could go through a handful of wonderful insurance brokers and insurance underwriters that have been fantastic investments over the years. Aon PLC being one of them. One of the reasons I wanted to highlight this company in particular in terms of why it's been not just a good business, but a good, creator of wealth is over the past, I want to call it 20 years or so. If you look at their financials, they've basically seen their returns accelerate. Their margins, the margins have been pretty consistent, but if you look at things like return on capital, return on invested capital, they've been accelerating for like 15, 20 years. And the biggest reason that's been happening is because they've been buying back stock by the dozens, by the handful, basically as much as they could get their hands on. Over the past 20 years, they've reduced their total share count by 31%. That's why, it only pays a really modest dividend. It's only like 0.8%. You're certainly not buying for a dividend, but because it's been such a, cannibalizer of its own shares, you've seen this massive acceleration of its returns on capital. And so when I, as an investor, see that, I see like a management team that is intensely focused on, growing the per share value for an investor rather than just kind of growing the business to make it bigger. Because a lot of times growing to get bigger doesn't create value. But if you're intensely focused on creating per share value for your shareholders, you're going to do very well. I think we've talked about a lot about other companies that do this in other realms, and Aon in insurance in particular has one that's done it particularly well. It's not, by my standards, it's not the cheapest company in the world. It's currently trading at about 23 times earnings, but for a business that has displayed such a consistent track record of value creation for its shareholders, that is not something I would be afraid to pay for, I guess you could say, in terms of things that I would be willing to pay up for.
Yeah, so I'm going to go kind of a similar direction. You mentioned we both picked from the B side. I think this is you mentioned a $1.8 billion investment before we were recording for Berkshire, which sounds like a ton of money, and it is, but it's,
But it's
half
Berkshire.
of 1%. Yeah, it's 0.5% of their portfolio. So this is Capital One. I'm a big bank stock fan. I own a lot of Bank of America and Wells Fargo. I almost talked about Wells Fargo before I forgot that Warren Buffett had sold it all today, because that's one of my favorite bank stock holdings. But Capital One is one that's really interesting to me right now. It's been on the top of my buy list for a little while, pretty much ever since they announced that they were going to acquire Discover, which I'll talk about that in just a second. But Capital One, a lot of people know it for its credit card business, and for good reason. To be honest, I know, Tyler, you said you used to live in DC at one point. I never knew they were an actual bank. I thought they were just a credit card company, because I had never seen a branch, but they're in the DC area for the most part. As soon as I went there I think I realized they were a bank when I went to Fool HQ for the first time in DC. They're a real bank. They are a full service bank. They have branches. They have their cafes, which are really highly rated, actually, in these days of online banking. And they are an online focused bank, or an online first bank, in the sense that they offer online checking accounts, online savings accounts. If I'm not near a Capital One branch, I can open a high yield savings account through Capital One. Their credit cards are the big part of their business. I don't think that's a big surprise to anybody. They're one of the largest regional banks in the United States. They have just under $500 billion of total assets. Really interesting business, very profitable banking business. The average credit card interest rate is about 25% in the U.S. right now. Say even Capital One pays 4.5% on its deposits. That's a lot of room for margin, even with a reasonable default rate. Right now, their net charge-off rate is just under 6%. That would definitely rise in a recession, but even so, that's a lot of wiggle room. Net interest margin is about 6.7% when all said and done. Very profitable bank. Most banks are in the 2 to 3% range. And valuation looks good, even by Tyler's standards. Capital One trades for about 0.9 times book value, about 1.25 times tangible book, one of the cheapest bank stocks that I've found in the market, especially banks that are that large and established and profitable. Really, really interesting opportunity. And speaking of interesting opportunities, they are set to acquire Discover either in late 2024 or early 2025 is when they think it's going to close. It's an all-stock transaction, so they're not actually paying money. They're issuing new shares of stock. And this is significant in a few ways. One, it might surprise you to learn that Discover has roughly 3 times the amount of credit card customers as Capital One. They have about 305 million versus about 100 million for Capital One. Discover is a big credit card operation. So it's essentially quadrupling their credit card business overnight when this happens in terms of number of customers. And there are some big efficiency advantages. I mentioned deposit cost. Capital One's deposit cost is surprisingly a lot lower than Discover's. It pays an average of 3% on its deposits versus about 4.4% for Discover. So by moving all of those Discover savings and checking accounts into its ecosystem, it could potentially lower the overall deposit cost of the business, not to mention the normal efficiencies by having one credit card leadership team instead of 2, et cetera, et cetera. But most significantly, Capital One is going to be the first big bank that I know of that is going to own its own payment network. You can argue that American Express fits into that category, but they're not really a branch-based, actual full-service bank in the same sense that Capital One is. Discover is a closed-loop payment network, meaning that it serves as both the card issuer and the lender. And Capital One will do that. It can move some of its own products onto Discover's network and stop having to pay interchange fees to Visa and MasterCard and things like that. The transition will be gradual. They've already mentioned that they want to move their debit card products over immediately to Discover, and over time they can do that. Capital One is a more deep-pocketed company than Discover and can invest more heavily in building out the payment network, which has had the number 4 share as long as I can remember. They said they want to keep the Discover brand. We don't know what that means at that point, but I think owning its own payment network is a big overlooked advantage to this deal. And Capital One deserves to be trading for a lot less than a 10% discount, or a lot more than a 10% discount to book. I think that's a really interesting Buffett stock to look at right now.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.